The crypto market hasn't just dipped, it's crashed hard, and it's shaken confidence across the board. Bitcoin, Ethereum, and most major altcoins have seen aggressive drawdowns, wiping out huge amounts of paper value in a short period of time. This isn't a random sell-off, and it isn't just crypto being crypto. What we're seeing is the result of multiple forces hitting the market at the same time. Macro pressure, liquidity rotation, leverage unwinds, and fading narratives, all stacking on top of each other. To understand what's happening now, you need to understand how the market actually moves. First, let's talk about scale. Since late 2025, the crypto market has lost a massive amount of total market value. Bitcoin has fallen roughly 50% from its highs, and many altcoins are down significantly more than that. This kind of move doesn't happen because of one bad headline. It happens when risk appetite disappears and capital starts pulling back everywhere at once. One of the biggest drivers is macro pressure. Global markets have been under stress, with equities selling off, volatility picking up, and capital rotating into safer assets. When the dollar strengthens and yields rise, speculative assets like crypto usually suffer. Despite all the narratives about crypto being independent or uncorrelated, in moments of stress it still behaves like a high-risk asset. When global liquidity tightens, crypto feels it fast and hard. Another major factor is institutional behavior. Over the last few years, institutions became a meaningful part of crypto demand, especially through ETFs and structured products. That worked both ways. When institutions were buying, they helped push prices higher. Now, as risk gets dialed down, those same institutions are trimming exposure. Outflows from investment products increase supply in the market, and when that selling meets weak demand, price falls quickly. Then there's leverage, the accelerant. Crypto markets are built on leverage. Perpetual futures, options, and margin trading allow traders to take oversized positions. That works beautifully on the way up and brutally on the way down. Once prices start falling, liquidations kick in. Forced selling pushes price lower, which triggers more liquidations, which pushes price lower again. This feedback loop is why crashes feel violent and sudden, even if the underlying reasons built up slowly. At the same time, narratives that supported higher prices have faded. Late 2025 was full of optimism, post-halving expectations, regulatory progress, and the idea that institutional adoption would create a permanent bid. When those expectations didn't immediately turn into sustained inflows or price stability, confidence cracked. Markets don't just price reality, they price expectations. And when expectations fail, capital leaves. Liquidity rotation plays a huge role here too. In uncertain environments, investors reduce exposure to volatile assets and increase cash positions or move into safer markets. Crypto, especially altcoins, is often the first thing to get cut. That's why you see broad-based weakness rather than isolated problems. Nothing necessarily broke, money just left. So what happens next? There are a few realistic paths forward, and the market will tell us which one we're in through behavior, not opinions. In the short term, heavy sell-offs often lead to consolidation or relief bounces. After leverage is flushed out and forced selling slows, price can stabilize and chop sideways. This doesn't mean the bull market is back. It means the market is trying to find balance. You'll often see sharp intraday moves, failed rallies, and a lot of frustration during this phase. A deeper scenario is an extended risk-off regime. If macro conditions stay tight, if equities continue to struggle, and if institutions remain cautious, crypto can stay suppressed for months. This doesn't look like a straight line down. It looks like lower highs, weak rallies, and slow, grindy price action that drains enthusiasm over time. The most important thing right now isn't predicting price, it's watching signals. The first signal is flows. Are large holders and institutions still selling, or do outflows start to slow? Stabilization in flows often comes before stabilization in price. The second signal is leverage. Watch funding rates and open interest. When leverage clears out and funding normalizes, the market becomes healthier, even if price is still low. The third signal is on-chain activity. If network usage, transactions, and stablecoin balances hold up despite lower prices, that suggests underlying demand hasn't disappeared. It's just cautious. The fourth signal is macro correlation. If crypto starts reacting less violently to moves in equities and macro news, that can indicate risk appetite slowly returning. Sentiment matters more than people want to admit. Crypto doesn't have traditional cash flows to anchor valuation, so behavior and confidence play a massive role. When sentiment breaks, prices overshoot to the downside. When sentiment recovers, prices often rebound faster than expected. Right now, the market is going through a reset. Leverage is being punished. Weak hands are being forced out. Expectations are being recalibrated. This is uncomfortable, but it's also how markets rebuild foundations. The key mistake most people make is assuming every crash is either the end of everything or an immediate buying opportunity. Reality sits in the middle. Markets move in phases. First comes the panic, then the stabilization, then the rebuilding of trust and liquidity. What matters most now is not guessing the exact bottom, but surviving the volatility with capital and discipline intact. Watching flows, leverage, macro conditions, and real usage will tell you far more than any single price level. This isn't about blind optimism or fear. It's about understanding that markets don't turn on emotion. They turn when conditions change. And those conditions always leave signals for people willing to look past the noise. Right now, the market is asking a simple question. Is there enough real demand to absorb supply at these levels? When the answer starts to shift toward yes, price will follow. Until then, patience, process, and risk management matter more than ever.